Welcome to Mistine Deep Dive. Today I am breaking down YMAX. This ETF is unique because it is a fund made up of other funds. Think of it like a basket of baskets. YMAX holds several YieldMax income ETFs that each use covered call strategies on high growth or high yield assets. These assets include well-known names in technology and crypto like Tesla, Nvidia, Bitcoin, and more. The idea is to layer monthly income from different covered call ETFs so as to create a powerful income machine. But this tool is not without complexity or risk. What is YMAX? YMAX stands for YieldMax Universe Fund of Option Income ETFs. It uses a fund of funds structure by investing equally in all available YieldMax covered call ETFs. Each underlying ETF owns a major asset and overlays a synthetic covered call strategy. That means it holds exposure to the underlying asset using derivatives rather than buying the actual asset. Then it sells call options on it to generate income. This income is passed up to YMAX, which then distributes it to investors. When new YieldMax ETFs launch, they are added to YMAX at equal weights during a monthly rebalance. How YMAX generates income. The process is layered. First, the underlying YieldMax ETFs sell call options on their assets each month or week. Those premiums generate income inside each fund. Those funds pay a monthly distribution to their shareholders. That distribution is what YMAX receives. Then YMAX collects all those incomes evenly across its holdings. Finally, YMAX distributes the income it receives on a weekly basis to investors. Recent income and composition. YMAX has a recent distribution rate of around 66% per year based on its most recent payout. Its SEC yield, which excludes return of capital, is closer to 89% per year. Its most recent distribution in early June contained about 73% return of capital and 27% actual income. That means most of the payout is return of capital, which lowers the fund value but delays the tax bill until you sell. Performance versus index. Since launching in January of last year, YMAX has returned 27% in total, which annualizes to about 19%. In comparison, the S&P 500 index has returned about 26% over the same period. While YMAX has matched or slightly outperformed the index when income is included, its NAV or price action has been volatile. In the first quarter, it dropped over 10%, while the S&P fell about 4% monthly payouts. YMAX pays weekly distributions. Recent weekly payments range between 14 cents and 21 cents per share, depending on market conditions. While this frequency can be attractive, it means you need to track these payouts and understand that the caps on upside can create erosion. Price participation risk. Covered call income comes with a trade-off. You limit your gains on the upside if the underlying assets rally. YMAX caps its participation in price gains while retaining full downside risk. That means its NAV can drop just as much as market index but will not rise as much when the market surges. It did lag the S&P in strong rallies and only matched with income included, but during drops it provided less cushioning. High expense structure. YMAX has an internal